Most people know Warren Buffett. Almost nobody knows the man Buffett called his greatest advantage. What if I told you that one billionaire quietly influenced trillions of dollars in investment decisions without ever becoming a household name? That man was Charlie Munger, and the thinking system he built over 99 years of life is the closest thing to a blueprint for extraordinary wealth that has ever been made publicly available. Stay with me, because by the end of this video, the way you think about money, decisions, and long-term success will never be quite the same. Here's a question worth sitting with before we go any further. Why do some people spend 40 years working hard, doing everything they were told to do, following every conventional piece of financial advice they were ever given, and still end up with almost nothing to show for it? While other people, sometimes starting with less money, less education, and fewer connections, manage to build wealth that compounds quietly for decades until it becomes something almost incomprehensible in scale. The answer is not luck, though luck plays a role in every life. The answer is not intelligence in the narrow academic sense, though Munger was undeniably brilliant. The answer is a way of thinking, a system for processing information, making decisions, and filtering out the noise that leads most people to make the same expensive mistakes again and again throughout their financial lives. Charlie Munger spent nearly a century developing, refining, and applying that system. Today, we are going to go inside it. Charles Thomas Munger was born on January 1, 1924, in Omaha, Nebraska. If that city sounds familiar, it should, because it is also the city where Warren Buffett was born, though the two men would not meet for another 3.5 decades. Omaha in the 1920s and 1930s was not a place of extraordinary wealth or privilege. It was a Midwestern American city shaped by the rhythms of agriculture and commerce, deeply affected by the Great Depression that arrived when Munger was still a young child, and reshaped the economic reality of virtually every family in the country. Munger's father was a lawyer, and his grandfather had been a federal judge, which meant the family had a degree of professional stability that many around them lacked during the Depression years. But what shaped young Charlie more than any material advantage was something that cannot be inherited or purchased. It was a consuming curiosity about how things worked. Not just machines or science, though he loved both, but systems, institutions, human behavior. The reasons why things happened the way they did, rather than some other way. He was the kind of child who read everything he could get his hands on, not because he was told to, but because the world genuinely fascinated him, and books were the best available technology for accessing more of it. He worked as a teenager at a grocery store owned by Warren Buffett's grandfather, though neither of them knew at the time what that coincidence would eventually mean. He was a strong student, attended the University of Michigan to study mathematics, and then left to serve in the United States Army during World War II, working as a meteorologist and eventually attaining the rank of second lieutenant. After the war, without an undergraduate degree, he applied to Harvard Law School, was initially rejected, and gained admission only after a family friend with connections to the school intervened on his behalf. He graduated magna cum laude from Harvard Law in 1948. What happened during these early years, the Depression childhood, the voracious reading, the mathematical training, the law degree earned without a conventional undergraduate path, was the foundation of something that would take decades to fully reveal itself. Munger was being shaped, without knowing it yet, into someone who approached problems from multiple directions simultaneously, rather than from within a single discipline. Most people who become lawyers think like lawyers. Most people who become accountants think like accountants. Munger was developing the habit of thinking like a mathematician, a psychologist, a biologist, a historian, and a lawyer all at once, applying whichever framework was most useful to the problem in front of him, rather than defaulting to the one he happened to have been formally trained in. This habit, which he would later formalize into what he called a lattice of mental models, was the actual source of his extraordinary investment insight. But we are getting ahead of the story. After Harvard, Munger moved to California and built a successful legal career in Los Angeles. He was a good lawyer, well regarded by clients and colleagues, earning a comfortable living. But something was bothering him. a feeling that he was trading time for money in a way that had a fundamental ceiling, that no matter how good a lawyer he became, his financial success would always be limited by the number of hours he could personally bill. He had read enough about business and investing by this point to understand that the people who built truly extraordinary wealth did so not by selling their time, but by owning things, by having money work for them, rather than only working for money themselves. This realization led him to start a small investment partnership on the side while still practicing law, essentially doing in a modest way what Buffett was doing simultaneously in Omaha with his own partnership, though the two men were still not yet acquainted. Munger's early investment results were strong, driven by the same voracious reading and cross-disciplinary thinking that had defined his intellectual life since childhood. He was looking for businesses that the market had mispriced, situations where the conventional wisdom about what something was worth turned out to be wrong, because most investors were only looking at the situation from one angle, while Munger was looking at it from 6. But success was not immediate, and it was not uninterrupted. The early years of Munger's investment career included real setbacks, periods of poor performance, investments that did not work out the way he had expected, and the particular psychological difficulty of watching other people make money quickly while you are taking a disciplined, patient approach that looks slow by comparison. The late 1960s and early 1970s were genuinely difficult years for Munger's investment partnership, as they were for many value-oriented investors, during a period when speculative growth stocks were dramatically outperforming the kind of careful, fundamentals-based approach that Munger favored. There were also personal difficulties during this period that went far beyond financial setbacks. Munger's first marriage ended in divorce. His son Teddy was diagnosed with leukemia and died at age 9, a loss that by any measure represents the kind of grief that can redefine a person's relationship with everything else in their life. Munger has spoken about this period with characteristic directness in later interviews, acknowledging that it was genuinely hard and that he dealt with it by continuing to work, to read, and to focus on the things he could control rather than being consumed by the things he could not. This response, stoic in the philosophical sense without being emotionally detached, reveals something important about the psychological makeup that eventually made him such an extraordinary long-term investor. He had developed, through genuine adversity, the ability to accept painful reality clearly and continue functioning effectively within it, rather than distorting his perception of reality to make himself feel better in the short term. Most people would have quit at various points during this period. Most people would have concluded that the investment approach was not working, that the personal losses were too heavy, that the path forward was too uncertain. Munger did not quit. He continued reading, thinking, refining his approach, and building the intellectual framework that would eventually make him one of the most effective investors in history. The meeting that changed investing history happened in 1959 at a dinner party in Omaha. Munger was visiting from California, and mutual friends arranged for him to meet a young investor named Warren Buffett, who was already developing a reputation in certain circles as someone unusually talented at finding undervalued businesses. The two men talked for hours. By most accounts, it was immediately clear to both of them that they were in the presence of someone genuinely unusual, someone whose thinking operated at a level and with a breadth that was not commonly encountered even among highly intelligent and well-educated people. What made the meeting historically significant was not simply that two smart people found each other. It was that their minds worked in ways that were complementary rather than identical. Buffett was a genius at identifying undervalued businesses, at reading financial statements with an almost physical intuition for what the numbers were actually saying about the underlying economic reality of a business. Munger brought something different, a psychological dimension, a deep understanding of how human biases and emotional patterns distorted both individual and collective decision-making, and a multidisciplinary framework that allowed him to evaluate businesses from angles that pure financial analysis missed. Two brilliant minds, different personalities, different strengths, the same fundamental mission of understanding how the world actually worked rather than how it was conventionally described. Buffett has said repeatedly over the decades that Munger expanded his thinking in ways that were essential to Berkshire Hathaway's eventual success. Specifically, Munger pushed Buffett away from the strictly quantitative approach to investing that Buffett had learned from his mentor Benjamin Graham, an approach that focused almost exclusively on buying businesses at prices well below their objectively measurable asset value, and toward a more qualitative understanding of what made certain businesses genuinely excellent rather than merely cheap. The shift from buying mediocre businesses at great prices to buying great businesses at fair prices was, Buffett has acknowledged, largely attributable to Munger's influence. And that shift in approach is a significant part of why Berkshire Hathaway's results over the following decades were as extraordinary as they were. Now we need to talk about something that most investment content completely avoids, because it is psychologically uncomfortable, even though it is absolutely central to understanding why most people fail to build lasting wealth. The reason most investors underperform over long periods is not that they lack access to information, or that the markets are rigged against them, or that they started with too little money. The reason is the way they think, or more precisely, the way their emotions interfere with their thinking at the exact moments when clear thinking matters most. Fear is the first and most powerful force working against the ordinary investor. When markets fall, when the news is terrible, when everyone around you is selling and the financial media is filled with predictions of further disaster, the human brain generates an emotional response that is very difficult to override rationally. The fear of losing more money, the fear of being wrong, the fear of looking foolish by holding on to things that are going down in value, creates an almost irresistible pressure to sell at exactly the moment when the historical evidence suggests that patient investors should be doing the opposite. Greed operates in the mirror image direction and is equally destructive. When markets are rising, when certain investments have been going up for months or years, when every conversation you have includes someone talking about how much money they made on something, the human brain generates an equally powerful emotional response pushing you to participate, to buy what has already gone up, to chase the returns that others have already captured. This is how bubbles form, and why ordinary investors consistently manage to buy near the top and sell near the bottom, achieving the exact opposite of what successful investing requires. Envy is perhaps the most insidious of the psychological forces that Munger identified as destroyers of wealth, because it operates so quietly that most people never recognize it in themselves. When someone else makes money faster than you are making it, the emotional discomfort this generates can push you to abandon a sound, long-term approach in favor of something that promises faster results, even when you know intellectually that faster results typically come with commensurately higher risk. Munger pointed out that envy is the one deadly sin that does not even feel good while you are experiencing it, unlike greed or gluttony, which at least provide temporary pleasure. Envy only makes you miserable, and then leads you to make worse decisions. Ego completes this destructive quartet. The need to appear smart, to be right, to not admit mistakes, is one of the most expensive character traits an investor can have. Munger was famously direct about his own mistakes, cataloging them publicly and without apparent embarrassment, because he understood that the inability to acknowledge error prevents the learning that would allow you to avoid making the same mistake again. An investor who cannot admit mistakes is an investor who cannot improve, and an investor who cannot improve is an investor who will eventually be destroyed by the compounding of their own unexamined errors. The solution Munger proposed to these psychological traps was not to pretend the emotions did not exist. It was to build a thinking system rigorous enough to override them when they became most dangerous. He called this system a lattice of mental models, and understanding what he meant by it is perhaps the single most practically useful thing you can take from his entire body of thinking. A mental model is a framework for understanding how something works, drawn from a specific field of human knowledge. Physics gives you mental models about energy, leverage, and equilibrium. Biology gives you mental models about evolution, adaptation, and ecological systems. Psychology gives you mental models about cognitive biases, emotional regulation, and social dynamics. Economics gives you mental models about incentives, scarcity, and market dynamics. Mathematics gives you mental models about probability, statistics, and compounding. Every serious intellectual discipline has developed, over decades or centuries, a set of frameworks for understanding reality that are genuinely useful and genuinely reliable when applied correctly. Most investors operate with mental models drawn from a single field, typically finance or accounting, and apply those models to every situation they encounter, whether or not those models are the most useful ones available for that particular situation. Munger's insight was that the investors, the business people, the decision-makers who achieved the most extraordinary long-term results were almost always people who drew on mental models from multiple disciplines simultaneously, finding which framework was most illuminating for a given problem rather than defaulting to the one they happened to know best. The practical implication of this insight is almost embarrassingly simple, though executing it requires years of deliberate effort. Read widely. Not just about business and finance, but about psychology, biology, history, physics, mathematics, and anything else that sheds light on how systems actually behave. Build a collection of the most powerful ideas from each of these fields, and learn to hold them all available simultaneously when you are trying to understand a new situation. And then, when you encounter a problem or an investment opportunity or a business decision, ask yourself which of your mental models is actually most illuminating here, rather than defaulting to whatever framework you are most comfortable with. This sounds abstract, so let us make it concrete with a specific example that Munger used repeatedly in his own teaching. When evaluating whether a business has a durable competitive advantage, most investors use purely financial mental models. They look at margins, returns on capital, earnings growth. These are useful, but incomplete. Munger would also apply a biology mental model, specifically the idea of an ecological niche. A species that occupies a specific ecological niche, one that is genuinely difficult for competitors to invade, survives and thrives even in adverse conditions. A business that occupies a specific economic niche, one where customers have strong reasons to keep coming back and competitors face high barriers to entry, similarly survives and compounds through business cycles that destroy less well-positioned competitors. Looking at a business through a biological lens reveals things about its durability that a purely financial analysis might miss entirely. Now let us talk about the concept that connects everything in Munger's thinking and is simultaneously the most mathematically simple and the most psychologically difficult idea in all of investing. Compounding. You have heard the word before. You may have seen the charts that show how a dollar invested at various rates of return grows over time. But understanding compounding intellectually and feeling it in a way that actually changes how you behave are two very different things. Munger understood compounding not just as a mathematical fact, but as a fundamental principle about how value accumulates in systems over time. A business that earns a consistently high return on capital and can reinvest that capital at similarly high returns does not grow linearly. It grows exponentially. And the difference between linear and exponential growth, which looks trivial in the first few years, becomes staggering over decades. A business growing at 15% per year is worth roughly 4 times as much after 10 years, 16 times as much after 20 years, and 64 times as much after 30 years. The math is the same at every step, but the scale of the outcome at the end is almost impossible to intuit from the beginning, which is precisely why most people underestimate it. The psychological implication is that the most important investment decisions are not the ones that produce the fastest returns. They are the ones that compound for the longest periods without interruption. Every time you sell a great business to buy a mediocre one that seems cheaper, you interrupt a compounding process that may have been extraordinarily valuable if allowed to continue. Every time you panic and sell during a market decline, you crystallize a loss that would have recovered and then some if you had simply waited. The enemy of compounding is not poor returns in any given year. The enemy of compounding is the impatience and anxiety that interrupts the process before it has had enough time to work. Delayed gratification is the human complement to mathematical compounding, and it is just as rare and just as powerful. Most people, given the choice between a smaller reward available immediately and a larger reward available later, will systematically choose the smaller, immediate reward, even when the difference in value is enormous. This is not simply a failure of self-control. It is a deeply embedded feature of human psychology, one that made perfect sense in evolutionary environments where the future was genuinely uncertain and immediate resources genuinely scarce. In a modern environment where the future is somewhat predictable and patient investment genuinely compounds, this same psychological feature becomes an expensive liability. Munger built his entire life around the discipline of delayed gratification. He did not spend his money to demonstrate his wealth. He did not seek public recognition for his investment decisions. He did not change his approach to match whatever the market was currently rewarding. He simply kept thinking clearly, kept making patient decisions based on long-term reasoning, and kept allowing time to do what time does when it works on compounding returns. The results, accumulated over decades, were extraordinary, precisely because they were allowed to accumulate over decades, rather than being interrupted by short-term thinking. Berkshire Hathaway's history is the most visible record of what happens when these principles are applied consistently over a very long period of time. When Buffett and Munger began running Berkshire Hathaway in the late 1960s, it was a struggling textile company worth a few $1 million. Over the following 5 decades, by making a series of disciplined investment decisions, by buying great businesses at reasonable prices and holding them for the long term, by resisting the pressure to participate in every investment fad that came along, and by reinvesting returns at consistently high rates, they transformed it into a conglomerate worth hundreds of billions of dollars, one of the most valuable companies in the world. The individual investment decisions that built Berkshire's record are individually interesting, but the more important pattern is in the aggregate. The companies they chose to own, businesses like Coca-Cola, American Express, See's Candies, Geico, all shared characteristics that Munger's mental model framework helped identify. They occupied strong economic niches. They had pricing power that allowed them to raise prices over time without losing customers. They had loyal customer bases built on genuine value rather than temporary price advantage. They required relatively little capital to maintain their competitive positions, and they were run by honest, capable people whose incentives were genuinely aligned with long-term shareholder value rather than short-term metrics. None of these characteristics are visible in a standard financial ratio. All of them are visible to someone who looks at a business through the multidisciplinary lens that Munger spent decades developing. Beyond investing, Munger had a great deal to say about the broader relationship between character and lasting success, and these observations deserve to be taken seriously rather than treated as pleasant platitudes. He believed, and argued with evidence, that reputation and trustworthiness were not simply moral virtues, but genuinely functional competitive advantages that compounded over time in much the same way that financial returns did. A person who consistently tells the truth, keeps their commitments, and treats the people around them fairly accumulates a kind of social capital that generates opportunities invisible to those who do not have it. People prefer to do business with those they trust. They refer opportunities, share information, and provide access to relationships that they would never extend to someone whose honesty or reliability they doubted. The returns on a reputation for integrity, accumulated over a career or a lifetime, are enormous, though they are almost impossible to measure at any given moment, which is precisely why they are so often undervalued by people focused on short-term outcomes. Munger was also unusually clear-eyed about the habits and behaviors that keep people financially trapped, despite good intentions and genuine effort. He identified several patterns that he considered particularly destructive, not because they were obviously wrong, but because they were seductively reasonable in the short term, while being quietly catastrophic over long periods. The habit of spending everything you earn, or close to it, leaving nothing to invest and compound, was the most basic of these traps. Not because spending is immoral, but because it prevents the accumulation of the capital that eventually allows money to work for you, rather than the reverse. The habit of chasing recent performance, of buying what has already gone up because it feels safe due to its recent success, consistently led investors to buy high and eventually sell low, exactly backward from what building wealth required. The habit of following the crowd, of allowing social proof and the behavior of others to substitute for independent analysis, meant being subject to whatever collective errors the crowd happened to be making at any given time. The positive habits that create wealth were, in Munger's framework, almost the mirror image of these destructive ones. Spend less than you earn, consistently and without exception, and invest the difference in things likely to compound over long periods. Think independently, gathering your own evidence and reaching your own conclusions rather than adopting the consensus view simply because it is convenient. Be patient to a degree that most people around you will find genuinely puzzling, because most of the returns in long-term investing come from waiting rather than from trading. And keep learning, permanently and across multiple disciplines, because the world changes and the mental models that are most useful change with it. As we bring this story toward its close, there is a question worth asking that Munger himself was fond of posing in various forms. If Charlie Munger had to start from zero today, with none of the money, none of the reputation, none of the decades of accumulated wisdom already in place, what would he actually do first? Based on everything he wrote, said, and demonstrated across a century of active intellectual life, the answer seems clear. He would read. He would read widely and deeply, across every field he could access, building the lattice of mental models that eventually became his greatest competitive advantage. He would find some way, however small, to begin investing, because the most important thing about compounding is starting it as early as possible and interrupting it as rarely as possible. He would be honest in every dealing, not because honesty felt good, but because he understood that the reputation built through consistent honesty was genuinely the most valuable long-term asset available to him. And he would be patient, ferociously patient, in a way that most people around him would find difficult to understand, because he knew that patience was the quality that allowed all the other qualities to actually produce results at scale. Charlie Munger died in November 2023, just a few weeks before his 100th birthday. He remained intellectually active, publicly engaged, and characteristically direct almost until the very end. The thinking system he built across a century of reading, investing, failing, learning, and compounding is as available today as it ever was, in his speeches, his books, his interviews, and the record of Berkshire Hathaway's decisions over 50 years. The question is not whether this system works. The evidence on that question is overwhelming. The question is whether you are willing to apply it with the patience and consistency it actually requires. Subscribe to Billion Dollar Stories right now if this kind of deep exploration of how extraordinary minds actually think about wealth and success is what you are looking for. Drop a comment below telling me the single biggest lesson you are taking from Charlie Munger's story today. Like this video if you made it all the way through, and share it with someone in your life who you think genuinely needs to hear this. We will see you in the next one.